Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is attorney and real estate expert Shams Merchant. Now, Shams is recognized as an industry leading commercial real estate and private equity attorney who advises clients on a wide range of commercial real estate and business transactions ranging in value from $1 million to over $350 million. Now, this expertise encompasses the purchase, sale, financing, leasing, and construction and development of both commercial and residential properties. Now, his experience runs the gamut of multiple asset types, including but not limited to retail, shopping centers, multifamily, office, industrial, hotel, data centers, sports and recreation facilities, adaptive reuse and conversion projects, and that's just to name a few of them. Now, his practice is Texas-based but national in scope and has represented some of the largest real estate companies in the world, including well-known private equity firms, private and public investment funds, regional and multinational corporations, and other real estate players. And so without further ado, I'd like to welcome Shams Merchant to the show. Shams, how you doing today?
Hey, doing well, Kevin. Thanks for having me, and thanks for that awesome intro.
Yeah,
Appreciate it.
excited to have you here, bud. Absolutely excited. I'm sure there's a lot more to it than just that. So how about we start there? For those folks that aren't familiar with you, Shams, tell us a little bit more about yourself, your background, and how you found your way into the real estate world.
Yeah, sure, man. So yeah, I'm a commercial real estate attorney, like you said. My firm is a real estate private equity law firm. So we handle everything related to real estate private equity transactions for our clients, from start to finish. That includes all the transactional work, like you mentioned. It also includes forming syndications and real estate private equity funds for these clients as well. So we kind of do everything from start to finish. Uniquely, we also have a built-in title company in our firm. So what that lets us do is also handle transactions from our internal title company as well. And so our clients pretty much get an A to Z one-stop shop, a service when they work with our firm. And yeah, my background, I started doing this about a little over 4 years ago, and always knew, when I went to law school, that I was going to become a commercial real estate attorney because my family was already in the business. So it was like a natural fit for me to become like a real estate lawyer. If I didn't become a real estate lawyer, I probably would have been a commercial real estate broker. So that
Got
was
it.
my backup plan. But I ended up going to law school and becoming a lawyer instead. And yeah, really much enjoyed, and I love being in the real estate, private equity field. I'm also an LP investor as well. So, it all just kind of fits in with what I do.
Yeah, interestingly enough, I feel like I know a lot of folks that maybe started in the legal field. They started as a lawyer and then found their way maybe on the LP side, and they found their way, well, I just get my brokerage license, and then they find their way on the completely other side of the table, right, running
Yeah.
syndications, and they move on from the law firm and kind of start their own thing. So anyway, it's both sides of the table, the opportunity that exists on both sides of the table, which is good. So you've got a good perspective, I guess the best way to put it. So
Yeah.
let's talk about I guess, what I'd love to get a sense of. So you work a lot with real estate syndicates and investors and what have you. Just, I guess, first and foremost, I think the one of the things that's on everyone's mind, it's always top of mind, especially since rates started taking a hike up a year and a half plus ago, and there's been chatter with the Fed that we're going to see some rate cuts later this year, but it has not happened yet. And
Yep.
along with those historical rate hikes has come a lot of pain. It's
Yep.
lots of challenges for different syndicators and folks that are out there raising capital from LPs. And so maybe just a general overview of what you're seeing. Again, you've got kind of a front row seat with a litany of different clients and folks that are in the field. You kind of keep your finger on the pulse of what's going on. And
Yeah.
so just tell us, what is going on? What are you seeing?
Sure. Yeah, no, that's a great question, and you touched on a lot of great points there as well. Yes, rates are still high, but we're all very optimistic, as you said, that the Fed is going to start making some cuts. So everyone's looking forward to that. I think the market has also started to respond to that notion a little bit as well, because we are seeing an uptick in transactions. I will tell you that the types of transactions that we're seeing today are more so transactions of multifamily private equity firms and syndicators coming in and buying properties. You're talking about 80s vintage, 70s, 80s vintage type properties from players who bought these at at the time when rates were low, and then they kind of got crushed when rates went up, and
Hmm.
now are looking to get out of those properties at any way that they possibly can, and they can't really get financing still for them.
Yeah.
Their lenders are breathing down their necks. So you're looking at these types of deals where you're having kind of the next phase of investors come in and buying up these assets at a really good basis. And these are the kinds of transactions that are penciling out today in the market. So we are seeing an uptick of those types of transactions. We're seeing a lot of dry powder as well that's been sitting on the sidelines also start being deployed. So if you follow the news, you've seen all the big real estate private equity firms, Blackstone, KKR, they're all active now, right? They're
Yep.
buying up huge portfolios of multifamily assets across the country, particularly in Texas and in the Sun Belt region. And so what that signals to the market for everybody is that when these players are jumping in, there's opportunity. And that's what we're seeing as well as kind of like a bird's eye view of what our clients are doing is that there is more opportunity that is now coming online into the market. And transactions are increasing in volume.
Are you seeing that a lot of the syndicators that are having those challenges with maybe some of this vintage class multifamily that they hadn't fully been able to maybe bake in their business plan or execute in their business plan until when the tides start going out? Are these mostly like smaller groups that might have just raised capital for a few deals, or are these some larger institutions as well that are having challenges?
I think it's both, and I think it's very sponsor specific.
Hmm.
I think it really just depends on what that particular sponsor did. But I think it's both. When it comes to the smaller players, I think for them is more so they just kind of have been waiting on the sidelines, and haven't been transacting at all. For the larger players that bought, a lot of assets at that time and that are now getting crushed, we're seeing still the headlines, of foreclosures, and we're still seeing, those assets being sold at, or being taken back by the lender. So we're still seeing those headlines, right? Like those headlines have not completely gone away yet.
Hmm.
But the flip side of it is what we're seeing is people are optimistic and opportunistic, and you see those people that are foreclosing or selling, but think about the ones that are coming in and buying, right? Those guys are getting excellent deals. So there is that flip side of the coin where yes, some players are getting wiped out, but there's this new wave of players coming into the market. And that's kind of what we're seeing as well.
Have you noticed of your clients that are presently raising capital, and this is to the small to mid cap size companies, those that are raising capital from the retail world, from limited partners that into retail high net worth accredited investors, are you seeing that given the shakeup in the marketplace? Obviously there's a lot of LPs that have lost money, that
Yep.
that, that are that had equity tied up in various deals that capital calls took place, obviously foreclosures as you mentioned, and so lots of retail investors, at least from what we've seen, there's
Yep.
definitely a lot of retail investors that maybe they're completely tapped out, or maybe they're just skittish at this point because a lot of the deals they've invested in just haven't done all that well. And so, what are you seeing? Are you kind of getting the same sentiment from your clients that are out there actively raising capital today?
Definitely. Definitely, I think capital raising today is much harder than it was a year ago.
Hmm.
That's the truth. That's evident, right? With no matter what your success story, what your history is, right? Even if you have done extremely well in the past couple of years, even today, capital raising retail investors, it's just much harder than it was a year ago. Because
Hmm.
like you said, investors are skittish. They don't know what's going on. They're reluctant to investor capital, and that's why you have all those dry powders still on the sideline. Um, it's a election year as well, so people are kind of waiting for that too, right? Kind of wanting to see what happens with
Hmm.
the election. Um, and so because of all those things, yes, capital raising is still hard, but I will say that if you are an operator that has a great track record, you will still be able to raise capital successfully. And if you have a deal, if you have a good deal, there is still capital available out there.
That's right.
It's a little harder to get, but it's surely there. And it's just a matter about being creative and going out there and still being able to get that capital, but it's there. And so the capital is still flowing to operators who have great track records,
Mhm.
who are finding great deals in this market. And there are plenty of those operators that are doing that.
Yeah. And I think a lot of it speaks to just, I had this conversation yesterday is just being those that were disciplined investors, during, call it late 20 and then 2021, 2022, when rates were just at historical lows before they took the run up. Those that were disciplined investors that were actually only buying stuff that truly penciled out, that that they could comfortably you get on board with the underwriting, and it wasn't just a, hey, rising tide lifts all boats. This thing's going to go up because the market's going up, but there's a real clear path to opportunity and value in this respective transaction. And I think a
Right.
lot of folks just lost their discipline for many years, and just, or again, it's kind of like a hot potato, right? And
Yeah.
just basically buying, knowing that they, in fact, I mean, there's a lot of, and I don't want to harp on multifamily because I've got a lot of my own capital tied up in
Yeah.
different
Yeah.
multifamily deals, so I love the asset class. But I will say that there was a lot of deals that I watched transact that had a business plan laid out, a 3 to 5 year plan, and then ultimately maybe that plan didn't even get kicked off. Maybe they did a rent increase, but ultimately they did, maybe they did, maybe only 10% of the renovations they were going to do, and then were able to exceed the returns, and so exit out of it early, which again, it's a win for everybody in that situation. But
Yeah.
I feel like folks, just assume that that was going to continue to happen. They would, I'll pay whatever I need to pay to get this,
Yeah.
and inevitably, I know that we're probably going to be able to exceed our business plan. Worst case, if we have to follow the business plan, great. But the last 7 deals we've done, we've been able to exit out, in half the time and just blow the returns out of the water. And
Yeah.
obviously, the music stopped, and that just was all no longer the case. But for those that are, I'm going to pat myself in the back here. We were really disciplined during that period of time, and
Yeah.
mostly because I didn't want to do this over again. '08 was really challenging for me and my business. It was the first, down cycle I had ever gone through. And so I was
Right.
not on the right side of the table when '08 occurred. And it took me many years to work through all those challenges. And I did not have the opportunity to be on the other side in, 2009, 10, 11, when there was a lot of distressed opportunities trading for just, again, historical low numbers. And I wish I was in a better state back then to be able to turn around and you be
Yeah.
recapitalized and ready to buy. And
Right.
so, while 2020 and 2021, 2022 was a frenzy, we sold a number of a number of our deals because just getting unsolicited offers that just made no sense to us. Us
Yeah. Yeah.
understanding the property, knowing the economics, owning it for a number of years, and then seeing the prices that were being offered, that there's no way to make it pencil. And so we sold a
Right.
lot. We did buy some, but not a
Right.
lot. I mean, we
Right.
definitely didn't see a lot of expansion or growth during those years when a lot of others did. However, last year was literally our biggest acquisition year ever.
Yeah. Yeah.
And when a lot of others were pencils down, we
Yeah.
had a phenomenal year last year, bought a lot of not distressed deals, but distressed opportunities, just the
Right.
partnerships that just had to exit. And a lot of buyers were pencils down. They didn't have the ability to take advantage of those opportunities. And it just presented a great thing for us. And
Right.
just,
Right.
I
And that's exactly like what my clients did. So what you just described about your business is exactly what we're still seeing more of today is those opportunities, right? And we only work with, clients who had that level of sophistication, who are, in this business for the long term, right? Those are the type of
Mhm.
clients that we like to work with. And they will say the exact same thing that you said, right? Is they had very successful 2022 and now did buy a lot of those types of deals. And those are the types of deals that we're seeing more of today as well.
Mhm.
And I think we'll continue to see a little bit more of that until rates get cut and the market gets hot
Yeah.
again, right? But when people are too scared to transact, those are opportune times for people like who have that level of sophistication like you do to go in and get great deals.
Yeah.
So when other people are scared, you
That's
should be
right.
bullish. That's the kind of approach that we've always heard, right? And it's in theory, it always sounds great, but it's harder to actually pull off in real
No,
life.
absolutely. Well, the interesting thing is that, buy when there's blood in the streets, and speak it back to '08. It's like, okay, well, that's really difficult when it's your own blood flowing through the streets, right? And so,
Right, right.
I didn't want my blood to be flowing through the streets this time around. And so again, it just, being disciplined and responsible during those, just crazy years has paid off well. We've slept well at
Yeah,
night, haven't
yeah,
stopped distributions. We've had 28 on time quarterly distributions. Never, the only time we ever saw a hiccup was for 1 month. when COVID started, we kind of just stopped distributions, paused them for,
Right,
I think it was
right,
about a 30-day delay.
right,
Once we realized the world wasn't going to end and most folks were still going to pay their rent, we started them up again. But outside of that,
right.
we've never had an interruption. So it's been a good run for us. But so I want to talk about the law firm. I mean, more specific to that, you guys kind of classify yourself as a boutique law firm. I guess I think most folks know what how one might define boutique, but I guess maybe speak to some of the benefits of working with a firm such as yours rather than that of a large national outfit.
Yeah, I mean, the first thing, first and foremost, is rates, right? When you're at a boutique firm that specializes in just doing one thing and doing it very, very well, you're going to get more of a better effective rate when you're out shopping in the market for an attorney or a law firm, right?
Hmm.
So for example, we handle private equity syndications and funds for real estate private equity firms, that have just are starting out, but also firms that have a couple $1 billion of assets under management, and all of that's still done on a flat fee basis, right? So all our private equity work, we handle on a flat fee. We
Mm.
don't like the idea of our clients being on the clock for securities matters because there's a lot of nuances there, and there's a lot of clients have a lot of questions. There's a lot of back and forth. We want to make sure that we're available and our clients never feel like they're being billed by the hour for stuff like that. So we handle everything on a flat fee basis for that. I have a big law experience, so I used to work at a really large law firm. It was actually the largest law firm in Texas. Um, and I will tell you that large law firms don't do that.
No.
They bill on an hourly rate, and those rates are extremely high. So that's kind of the unique model that we have as well. And then, like I mentioned, we combine that with a robust and sophisticated commercial real estate practice as well. So our clients don't have to go to multiple law firms, which is an issue that a lot of our clients had before they switched over to our firm, was they would have a law firm that handled their real estate transactional matters, another attorney that did their private equity and their syndication matters, and then
Sure.
they had another title company that would handle the actual closing, right? We just combine all three. And so once you're in our ecosystem, our clients never want to leave because they have everything they could possibly need under one roof. And then one more unique thing that we do that very, very, very few law firms in this space do is we actually help our clients with some capital raising as well. We're not broker dealers, but we have someone on our team. His title is a director of strategic partnerships, and his only job is to connect our clients with each other, connect our clients with LPs and high net worth family offices and individuals. And so that's
Hmm.
one thing that we also facilitate as well.
Interesting. Just curious. And no, that's great. That's an interesting service. I've never heard of a law firm offering that. Just curious as to how long you guys been. Is that a recent service that you just started offering, or is that something that you've had for quite some time?
Yeah, I mean it's more recent than the inception of the firm back in 2017. The firm did not
Hmm.
have that back when it was started
Yeah.
by the two founders. But what we noticed was that a lot of our clients have need this, right? They need help with capital raising, right? They might be doing a $10 million raise, and they might be short $1 million, right?
Hmm.
We can easily go out and help them get that additional $1 million by just connecting them with our network, right? We have such a huge network of clients that we work with in this space. I mean, we know everyone in the space, so we've kind of created something where we're able to just go out there and get them those contacts, those connections, and then obviously our client has to go and close those deals, but we
Sure.
put them in touch with the right people to be able to do that. And
That's a
it's just
great
something
value
that came
add.
out of a need that we saw that our clients had.
Yeah, no, that's fantastic. I love that. I love that. So let's switching gears a little bit. I know you've per your resume, it looks like you've been involved in a number of adaptive reuse projects. I mean, just
Yeah.
curious to hear about any ones that come to mind, but more specific. I mean, are there any of recent or that maybe you're involved in at present time that are conversions of office over to whether it be multifamily or some other type of use?
Not currently working on one right now, but I have
Okay,
worked on those types of projects before. And they're very challenging, I'll tell you that. Adaptive
sure.
reuse is one of the most challenging types of, projects that you can do as a real estate entrepreneur, right? As a
Hmm.
real estate investor. Um, to pencil out something like that is very difficult, right? And so very few what we've noticed working on projects of that type is very few buildings actually make sense to be able to convert from an office
Mhm.
to a multifamily. It's so few. It's like 1% of like 1%. Like it's like very,
Why is
very,
that?
very few.
What are some of the specific reasons? I've heard that too. I don't
Yeah.
know enough. I've never gone down that path to actually to understand what the reason behind that
Oh,
is.
it's really just the way that these buildings are built, right? When you have a multifamily building, you have certain infrastructure and engineering that's done for each unit, right? You have an AC unit for each, potentially for each residence, right? For each unit. You don't have that in an office building, right? So you have to create that, right? And
Mhm.
and the infrastructure of those buildings just doesn't support being able to sometimes do stuff like that. The construction of the building itself just isn't viable to be able to do something like that on a cost-effective basis, right? That's why it doesn't pencil out sometimes. Now, there are cases when it does, right? For example, we did a mixed-use development in Houston that was an adaptive reuse play that used to be industrial warehouses, and they were converted into this gorgeous retail development.
Hmm.
And then our clients also built a multifamily project right next to it. But that was easy to do because industrial warehouses are just big boxes.
Yeah.
And so you can easily convert them into like a retail development and put in everything that you need to be able to service, food and beverage type retail clients as well. And so they created this massive, development, by converting a massive retail development, mixed use development by converting old office not office, industrial warehouses. And so those are types of projects that have penciled out a little better. The office to multifamily is much harder. Um, what we've also seen recently is we're doing one deal where we're converting a office into a hotel.
Okay.
And that also is kind of similar to multifamily. But this building is in downtown Houston, and it does fit the criteria of being able to, pencil out that deal. And so our clients are pushing that deal forward, and it's going to happen. It's going to be, I can't tell you too many details about it, but it's going to be a nice hotel brand that they're putting in there. It's going to have a flag for a major hotel franchise in downtown Houston. It's old office building. It's been in downtown Houston for 85 years. And they're going to convert that to gorgeous hotel. So that's an adaptive reuse play that we're helping one of our clients
Got it.
with as well. So
How about
so
malls? I saw that in the resume as well. Some
yeah.
adaptive reuse projects dealing with malls. Talk to me about any of those that you're
Oh yeah,
involved in.
malls are another big challenge. Here's what most of our clients are doing at malls. They're buying these old, um, you know, uh, indoor malls and
Mhm.
converting them into these gorgeous outdoor mixed use developments, right? So take your traditional indoor mall and imagine pretty much cutting it up into pieces and creating an open air type of development with housing around it as well. Those are the types of projects that our clients are doing with malls. It's way more challenging than even
I
even
bet.
even the
Yeah.
multifamily conversion. But really, what they're trying to do is add in a lot of green space and amenities in order to be able to re-attract people to that destination.
Are there
A
some
lot of it has to
projects
do
right
with
now that are in the works that are your clients are doing with malls?
yeah, one of them, it's not a current client. It's a client that I've worked with in the past. They're doing one out in Plano here in near
Okay.
Dallas, and they're taking the Plano Mall, the old Plano Mall that used to exist, and converting it exactly what I said into is open air type concept. And we're seeing a lot of those types of deals also happen across the country as well. A lot of other players are doing the same thing. We're not actively working on any deals like that right now, but that is one group that we work
Interesting.
with that is doing a deal like that. And it's obviously such a long project. It's still in the works. It takes many years for to be able to pull something like that off. And so they're still actively redeveloping that project.
Yeah. Yeah. Good deal. What else, Shams? What else might we hit on that you feel is relevant to the listener base, whether it be about your law firm, the services you guys provide, again, just again, what your pulse of the marketplace, just anything and everything. I mean, I'm open book over here
Yeah,
and open forum
yeah.
for you.
I mean, I think your show is such a valuable a show for a lot of LPs out there, including me, right? I'm an LP investor. I listen to your show all the time. I learn a lot, even though I'm already in the space. There's just, when you approach deals from an LP point of view, it's different than when you're working with clients who are actively doing, who are sponsors and who are, actively doing these projects, right? Um, and so, I think from an LP perspective these days, um, I have, been evaluating, various types of projects, and I guess the way I approach them these days is kind of what you mentioned, prior, is I really look at the sponsor's track record. It's something that
Mhm.
I didn't used to do before. When I would invest in deals, I would look at the project mostly itself and say, hey, is this a project that I want to, invest in? Is this a team I want to invest with? Now I more so also look at, one, is this a project that I'm interested in investing in? Does it meet the criteria that I have for myself as an investor? Two, do I believe in the team? And three, what's your track record been in the past 5 years?
Yeah.
And it's something new that LPs are now starting to, look into. And I'm not sure if you're seeing something similar like that on your end as well.
Yeah, no, absolutely. I mean, I've always been that way. I guess, again, just kind of, I've been a full-time investor for 20 plus years now, so I kind of been through, every different part of the cycle, and I've got my money with a number of different syndicators outside of our own deals, and I'm pretty critical about, the last, call it from anyone that started buying in 2010 on. I mean, it was you could be a pretty horrific operator and still make a lot of money if you actually just
Right,
bought the deal right. You know what I mean? Again, the
right,
rising tide lifts all boats. And so I've always been pretty critical about like who's kind of running the show. I mean, the project's important, but I think more important to that is the individual running the show. Because you could take you and I both could, or pick anybody. Like I might find a mobile home park that's worth, 10 million bucks, and we could pick it up for 7 million. That same mobile home park, maybe my competitor that could pick it up for 7 million. Literally, it's going to be his first deal. He doesn't, he's nowhere nearby. He doesn't have any infrastructure within the company. He just knows that he's buying it at a discount. It's like I would probably, again, if I didn't know myself, all I knew was my track record, I would bet on myself versus that guy that's buying it for the first time, right? It's all about,
right,
what have they been through, and then also personally, outside the raising capital to do the deal, but what happens if something does go wrong? I mean, there's always unexpected. I mean, do they have the personal financial wherewithal? Like, what will happen when things really hit the fan? Will they have the
right,
wherewithal to actually step in and actually help with the financial support that's necessary to to see the deal through, right? And I think that's what I've been seeing a lot of with maybe some, and this isn't the hard. Everyone's new at some point, right? And so this isn't saying like this is what I'm seeing with all the a lot of the newer syndicators that kind of came out of the woodwork over the past 10 years. I don't want that to sound derogatory because everyone's new at some point in time. Like you got to get started somewhere, right? But I
exactly.
think the biggest challenge with that is them raising capital from their networks, friends and family, coworkers, things of that nature, and they really are don't have necessarily any money to put in the deal. Their kind of involvement or I guess participation in the deal is them raising the money for it, and so they're raising all the money, but they don't have a nickel to rub together themselves. Maybe they got some fee income coming from the deal. Maybe they're going to get a piece of an acquisition fee or something like that. But realistically, like their personal balance sheet is not strong in the event something does go wrong. Like they can't step up. Not that they would handle the brunt of it because LPs are partners as well, right? Like we're kind of in this ride together. But it does make me feel a lot better knowing that the lead sponsors actually have some financial clout. And it's not
Yeah.
just fee driven clout. Like they've got money in their bank account, like their personal balance sheet's strong, their company balance sheet is strong, so that in the event one deal has some challenges out of the portfolio, um, there's multiple solutions to actually
Yeah.
fix it to where it
That,
doesn't completely
yeah.
throw everything in disarray. So, for example, I've got some capital with a group. I'm not going to name the group, but it's a medical office fund. They've been around for like 40 years. I mean, it's a generational family. They've been doing it a
Yeah.
long time. And just I know the founders of the company. They're very well off, and I also know enough about them and their reputation. They care so much about their reputation that in the event something ever did go wrong or a deal just didn't didn't meet a projection that they set forth or had unexpected capital expenditures that came out that would allow them to go back and actually do a capital call and pull money from investors if it wasn't available inside the deal itself, they wouldn't do that. I know for a fact they wouldn't do that. There's no
Right.
way that just their reputation alone, they would make up for it and then they would move on.
Right.
And they have
Right.
the financial wherewithal to do so. And
Right.
like I like that. That makes me
Yeah.
feel good. So that's what
I
I really look for.
yeah. I
Experience,
think
but
yeah.
also financial capabilities in the event something goes sideways. Because it inevitably it will at some point,
Right.
whether it's due
Right.
to rising interest rates or something didn't get fully uncovered during due diligence. Like there's
Right.
just so many things that can go wrong in a deal, and it will. Like I forget what the old saying is about a pro forma, right? I can promise you one thing, that it's not right.
Yep.
I'm either,
Yeah. Yeah.
yeah, I'm either gonna, it's either gonna, I'm either gonna, exceed expectations or not meet them.
Yeah.
But I can
Yeah.
promise you that it's not going to do exactly what that pro forma shows it's going to do.
Exactly. That's a good way to put it. And I think you bring up a good point of something that we've been seeing a lot recently is and I'm sure you're familiar with this concept. It's a fund of funds. A lot of
Yes,
our clients are doing funds of funds, and it's a really hot item right now. We get a lot of new clients who want to do this model. And it kind of touches on kind of what you just mentioned is a lot of these fund of funds, they're not operators. They're just raising capital to go invest in an actual operator's deal. And they themselves don't have really any skin in the game. They're just putting together a bunch of LP capital as a fund and then going into someone else's fund. What are your thoughts on that? Because it is something that is very gaining a lot of traction. A lot of
yeah.
people are doing this right now.
Same thoughts. I mean, same rules apply. I mean, I know many fund to fund operators that are actually really sophisticated guys
Yeah,
that run a tight ship and actually have a strong financial acumen. They've got a finance background. They're not your standard, hey, I just heard about this real estate thing where I can make money as long as I go to
yeah,
my friends and family and colleagues and tell them about a deal, and I bring the capital and I get a slice of the deal, right? Like, so like I think there's definitely way more of the inexperienced fund the funds guys out there doing deals
right.
than that of those that actually are putting it putting it together and operating it more like a maybe small scale institutional fund. Like it's
Yeah,
more on a
yeah, yeah.
professional level.
We have a client who's doing that, very sophisticated, and the value that they provide. I've invested with them as well. The value that they provide is they're able to go in. They'll go in, do their due diligence on 200 potential projects, right? So instead of me having to go and
That's
vet
right.
each deal, they'll do it for me, and that's the benefit that I get is I'm investing in something that they've already figured out that this is
That's right.
and that's the
But they know what
value.
to look for. They know what to look for, and
Exactly,
they probably,
exactly.
it's not just them as an individual. They probably have an analyst on their team.
Yep,
They've got someone that's got maybe if they're looking at value add projects, they got someone on their team that's maybe an engineering background, a construction
yep,
background, like, or they have it themselves. But like they've got they're multifaceted. Like they've got
right.
they're running it as, I mean, there's real fun to fund groups, institutional groups out there that are fun to, so like the
They're fun to
model is
fun.
not a,
Yeah,
it's not a
yeah.
new model. What's new is
No.
that it's really it's attracted that of small time investors that literally they'll have a fund to fund, they might raise $1 million
Yeah, yeah.
amongst 20 different investors, and then go
Right,
invest in one or a couple different deals, right? And so now they're a
right.
fund operator, but it's not the same as what you and I might perceive to be as a fund operator. When I think of a fund operator, I think someone that's managing probably hundreds of millions of
Exactly,
dollars, right?
exactly.
Um, and so I think you just have to be weird, just like anything else.
Yeah,
It's all about understanding who's running that fund to fund, what value they bring. I think the one value a lot of times they can harp on is if they can bring enough capital, they'll get stronger economic terms. They'll get beneficial
exactly,
terms than that of what maybe you might get as an LP that's going directly to the deal yourself.
exactly.
Um, but I think just eyes wide open, understanding who's running that fund to fund,
Yep,
and you know what due diligence have they really done outside of just
yep,
reading the OM and
yep,
the pitch deck,
yep.
and do they know to ask the right questions? Are you getting
Right,
are are you getting into the right deal? Like that's it. I mean, if you
right,
don't know how to answer that, and the fund of funds guy doesn't know how to answer that, then like I don't know if you're gaining a benefit, even if you're getting better economics, because you still don't know. Like no one knows that you're investing with if it's a great deal, if it's going to
right,
actually, you know,
right,
meet or exceed your expectations. So
right, right. Yeah, like you said, yeah, pros and cons
yeah,
to
but
both.
track record, it's all goes
Yeah,
back to track record in that scenario too. So
right, right.
whoever that fund of
And
fund
yeah,
is actually investing with, what is there? That's one thing. Even if you're an inexperienced person that's putting money into a fund to fund, that's going to, in turn invest it, into a syndicate. The one thing you can do as an LP, like you could still, you don't need to know a lot to ask basic questions about how long you've been
Yep.
doing this. Like, what give me the last like 5 deals you've done. Like,
Yep.
what'd you buy? What'd you sell for?
Yeah.
What was the
Yeah.
business plan? Did
Yeah.
you execute on it accordingly? Go
I,
visit the properties,
I agree.
and
Yeah, I think you still have to do your own due diligence as an LP, right? You can't
yes,
still rely just
absolutely.
on who you're investing with in a fund to fund to be able, for them to do their own due diligence, right? Like
That's
you
right.
should also take that extra step and do your own due diligence into the project itself, right? And into the actual operators themselves. And we touched on this in the beginning of the show, right? Like it is something that, you should do even if someone has already vetted them for you. I think you still need to take that extra step and vet them yourself.
Yeah.
Make sure you're protecting your money. But
Unfortunately, I think a lot of the
I
smaller fund to
yeah.
funds. Unfortunately, I think a lot of them are probably having challenging, and again, this isn't this. I don't mean this in a derogatory manner, but it's
Right.
kind of. I think it's the truth because there's a lot of them out there that maybe have only raised a few $100,000, a few $1 million, and a lot of it was from their immediate friends, family, and coworkers. And they're in situations now where those deals are not going well. There's capital
Yep.
calls, and like they're
Yep.
having a very difficult time sitting around the Thanksgiving table. It's just
Yep.
that's that, and they have
Yep.
no control. Like they have no control
Right, right.
whatsoever.
They're
And
just
if
an
it's
LP investor in
that's
in
right,
in in, in that deal.
yeah,
Exactly. Exactly. Yeah, yeah. It's important for anyone investing in a fund to fund to understand the model as well, right? Understand what you're investing in, right? Which per the SEC, by the way, you're actually not investing in real estate. By the way, when you're investing in a fund to
right,
fund, you're investing in you're buying into membership interest into that entity. You're not a real estate investor, and it's not a real estate investment. That's a nuance also is a lot of real
that's
estate
right.
securities lawyers don't even know this is you're not actually investing in real estate when you're doing a fund to fund model. So it's really important to make sure that as an LP investor, you understand some of those nuances too. Um, and as a someone who's a fund to fund operator, you also want to make sure your documents are drafted in a way where it's not there's specific provisions and disclosures that you need to make to your investors that are completely different than if you were doing an actual syndication or a fund that's actually operating the real estate, right? So we've seen documents from some fund to fund operators before that are incorrect because the attorney that drafted them did not understand that this is not a real estate investment. This is an investment into a membership interest into an entity.
Hmm.
And the SEC requires different disclosures for that. And so, another
Well,
nuance that
well,
most people are
that's
not
scary.
aware
That's
of.
scary to think that maybe some securities attorneys actually don't understand that
It's
it's
such a
not.
nuance. Well, yeah, and because
Yeah,
it's now more prevalent, right? It's the fund to fund model is now becoming more, mainstream, right? Like how syndication is now, right? And it wasn't 5 years ago. And so, attorneys that have recently started doing this type of, syndication or fund formation type work, they don't understand that nuance.
right.
And so that's
Yeah.
always scary as well. But yeah, no, excellent point as well, Kevin, on
Well,
on that. So
well, Shams, this has been a great conversation. A lot of fun having you, buddy. I mean, I want to
yeah,
be respectful of your time here and of the time of the audience here. So, for those that want to learn more about you and your firm and get in contact with you, what's the best place to where's the best place to track you down?
yeah, you can go on our website. It's mwfirm.com, www.mwfirm.com. The name of our law firm is MW Law, and we're based here in Dallas, Texas. And if you Google us, you'll be able to easily find us as well. You can also search me on LinkedIn. Just type in Shams Merchant on LinkedIn, and you'll find me on there. You can connect with me on through the website or through LinkedIn. My email is also shams@mwfirm if you want to directly email me as well. So.
Got it, guys. We'll make sure we get all that in the show notes as well. And Shams, it's been great having you, my friend. I appreciate you
Yeah.
coming on the show.
Thanks so much, Kevin. It's been a pleasure. Again, like I said, big fan of your show, and I'm gonna continue watching and learning from you, man. So I really appreciate you having me.
I appreciate it, brother. And guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.